Well, obviously, a beat is always better than a miss. So I think that's obviously some good news. It looks like the margins came in a lot better than what expectations were, about 80 basis points better than consensus. We're going through the report right now, so we're trying to figure out where that beat was. But overall, it looks like a very good print for the company, especially given the challenging environment, whether it's them grounding the MD-11s or the end of the de minimis exemptions. Looks like they're working through that through their restructuring programs.
That's the global trade policy changes that you're talking about, right?
Yeah, they the de minimis exemptions, which really impacted low value freight, so freight that was coming in from other countries that were worth $800 or less. It didn't have to pay duties. The Trump administration ended that loophole that was had pretty much bipartisan support, and what that did is just reduce the amount of traffic that they were shipping via air freight coming into the U.S. And eventually some of that freight's going to work its way into the ground network, but definitely a headwind that it looks like they were able to overcome.
You mentioned the grounding of the MD-11. UPS also a user of MD-11 freighters. Those are grounded after the tragedy in Kentucky just a few months ago. Lee, how has FedEx been able to make up for that?
That's a great question. I mean, what they would have to do is they have to go out into the market and they would have to lease planes to, if they didn't have anything that they can put into service quickly, so they would have to lease planes, and that would obviously weigh on their overall costs. But like I mentioned, it looks like they were able to overcome that given the fact that their margins came in better than expected. And revenue beat by 3%, but earnings beat by 17%. So it looks like they're doing a really good job on the cost side.
Hey, shares of FedEx, Lee, are up about 26% in the past 6 months. That's at least through yesterday's close. Those of UPS have risen less than 2%. I know they're not the same kind of companies, different business models, but why is there the difference? Is it all about this restructuring and separating out of the ground and cargo systems for FedEx? And, is that the reason?
Yeah, if you looked at the shares over a longer period of time, they'd probably be a little more equal.
Okay.
But UPS, it's kind of like almost watching a horse race. One is doing better and the other is trailing, and then the other one is doing better. I think since FedEx's last earnings 3 months ago, people were starting to buy into the fact that management's going to be able to execute on their plan. With FedEx, it's always been an execution question. Are they going to be able to do this? Because they kind of dragged their feet for a long time to restructure their network, and they really seem to have leaned into it and really getting the savings that they are hoping to get out of that restructuring.
Hey, one of the things I want to ask you, I think we always thought, I don't know, it's a conversation we used to have at home a lot, is that with everybody buying so much online, that UPS and FedEx and all the delivery companies were going to be just fine. They were going to do well. It was like the ultimate kind of internet play. Why has that changed? Is it because Amazon's got into doing its own delivery? Like, what has changed? Or maybe that wasn't a really good thought or narrative before.
Well, when you're thinking about demand, it's an absolutely the right way to think about it. The problem was FedEx and UPS were created to do B2B, business to business. So, you go to a lawyer's office, you drop off 100 envelopes and you pick up 100 envelopes. Delivering to people's houses is much more expensive. So that B2C, business to consumer traffic, it tends to have lower margins. And what UPS and FedEx are trying to do right now is to restructure their network to this new reality of that's where the growth is going to be. I mean, obviously, they're going to be able to hopefully grow some of their B2B businesses. They're looking to get into, more specialized verticals like healthcare. UPS has really said that they want to grow significantly in that market.
But they've been talking about that for a long time.
Well, it takes time. It does take time. These are very asset-intensive networks. You can't just turn on a dime. And they're also employing a lot more automation. And those are expensive investments that they have to make. And they're looking to restructure their overall footprint because they might not need the same amount of facilities that they did when they were doing mostly B2B traffic. And now that they're doing B2C, they can do things differently. And for a FedEx, they operated a very separate express network and ground network. the ground network, those trucks that you see, those are independent contractors, but the express network are mostly employees. And now, they're working their way into combining those two networks, which is something that, the street was always scratching their head on why they never did. At the time, management used to say that it provided value, but I think, like I mentioned earlier, it seems like they're finally leaning into, the new realities of their business, and they're cutting the fat that they
Right.
had in their organization.